Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Last week, Intel announced that its CEO, Bob Swan, will be stepping down effective next month. His replacement is Pat Gelsinger, VMware's current CEO and former Intel CTO. The market liked this news, and Intel's share price rose by more than 7%. So, with a new CEO coming in, do Intel's shares look good for a recovery play? Before we look at that, let's take a brief look at Intel's market position now. Back in the old days, Wintel, Windows and Intel, dominated the personal computer landscape. Both companies worked side by side to create market-leading PC products year after year. That was then. Now, Microsoft remains a leader in operating system and cloud computing. Intel, however, appears to have fallen behind significantly. This is not to say Intel is approaching its own Kodak moment. Far from it. The company remains a profitable juggernaut. Last year, it earned about $25 billion pre-tax, and its $218 billion market cap is among the world's largest. What Intel lost over the years is its core competitive edge in CPU innovation. The company is no longer the sector leader in making microprocessing chips. Taiwan Semiconductor Manufacturing Company is better at that than Intel. Unsurprisingly, TSMC is twice the size of Intel and commands a market value of $550 billion. Intel's problem lies with the next generation chips. According to Moore's Law, the number of transistors in a microchip doubles every 2 years. Keeping up with Moore's Law was relatively easy in the 90s. But as more and more transistors are packed into the same space, Intel started to struggle. Throughout 2018, it failed to produce the 10-nanometer chips efficiently, and last July, Intel admitted that its next-generation 7-nanometer chip production was falling behind schedule. That announcement alone caused Intel's share price to plunge 16% overnight, as investors lost faith in its next-gen chips. Intel's problem in producing the 7-nanometer chip runs so deep that the famed chip maker is now considering outsourcing the manufacturing process for that product. Meanwhile, Intel's competitors are stealing a march on the company. For example, AMD is already selling 7-nanometer chips, and TSMC is starting to produce 5-nanometer chips for Intel's competitors. Next year, we will probably see the arrival of 4-nanometer chips. The chip sector is also shifting. NVIDIA is buying ARM from SoftBank, and in recent years, ARM's architecture is increasingly popular for powering portable devices. For example, Apple is designing its own chip using ARM's technology. Amazon Web Services is also building custom processors with ARM architecture. This only exerts increasing pressure on Intel. So, back to our question, should we buy Intel? Our proprietary search tracking tool, Trackstar IQ, shows us that over the past few weeks, 90 institutional investors on Wall Street researched this stock 134 times. And what is clear from the market is that Intel is viewed as a value play. For a leading tech stock, this is outright dangerous, because in the fast-growing and hyper-competitive tech sector, a maturing cash cow means the company is no longer innovative. In turn, this means that the company may lose its market share over time, unless it can find new areas of growth. Clearly, the company sees the danger, hence the new CEO appointment. With his engineering background, investors think Pat Gelsinger is a good choice to correct Intel's problem and drive Intel's innovative efforts once more. Remember that Intel is still the largest chip maker in the world. Its balance sheet is secured. Billions of free cash flow are available for R&D investment, and the firm has a huge team of engineers. If led effectively, these financial and scale advantages could see the company regain its competitiveness in chip innovation. Moreover, apart from its PC chips, Intel saw some growth in its data center chips. Overall revenue this year is likely to grow modestly. Still, some think that the company is a classic value trap with little or no growth. Competition is intense, and the company will struggle to regain its market dominance. That's why Intel's share is valued cheaply these days. Investors can't see how the company can extract itself from the quagmire. But things can change over time. Some traders may prefer to wait until concrete results are produced before piling in. By then, it may be too late. A better strategy may be to use Intel's share price to guide us. Currently, it is boxed in at $45 to $60. Investors may see value in the recovery story when prices break out of the range, say above $60. New all-time highs above $70 means investors are expecting big positive changes ahead, and momentum should carry it higher. On the downside, if Intel's problem proved too stubborn to tackle, this will manifest itself soon enough on the stock. If holding long positions, stop losses are advised at the bottom of the range near $45. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.